Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, it's amazing the difference a couple of months make. Earlier this year, we were bemoaning or really worried about markets, and it will lead us into the option structure that you're going to talk about a little bit this evening. But here we are, close to approaching and breaking all-time highs.
Yeah, that's right. And I mean, when we look at the S&P 500, which is the chart that's up on the screen at the moment, there you can see it quite clearly that we started the year negative. Very weak January and into February, the markets were looking quite scary at that point in time. But since then, since the middle of February, the market's been rallying up. And you can see now, basically, this S&P 500 is once again knocking on prior all-time highs. I think the actual all-time high for the S&P 500 was 2134, and in the futures today we're up at about 2116 last time I looked. So it puts them now less than 1% away from the all-time high, which a few months ago didn't seem very likely at all.
And the volatility's dried up at the same time.
Totally. I mean, I don't have a chart of the VIX here, but if I was to show you the VIX chart, it's basically crawling along the bottom of the VIX, which is probably the lowest type of volatility environment that we've seen for ages on the VIX. And it makes trading quite difficult. And if you really, I mean, if you just look at this S&P 500, you can see that really since late March, it's mostly just gone sideways. And the trading ranges for each day have been relatively narrow, not a great deal of volatility, certainly nothing like what we saw in January and February here, where we saw fairly broad trading ranges on a day-to-day basis. Now, you're seeing very, very narrow trading ranges from day to day on the S&P 500. It actually makes it rather difficult as a trader to try and take advantage of any movement because there isn't much movement.
And maybe there's an argument to buying the VIX at this point because you want to buy it when there's not much volatility to hedge yourself if there suddenly is volatility. But if we move from the US markets to our own markets, I mean, we're not too far away from piercing through those all-time highs.
We're not that far in our market, no. Our market high on the top 40 was at about 49,200. And today we've been trading around about 48,000, that sort of area. So not that far away. What would that put us? About 2.5% away from our prior all-time high. If you look at this graph of the top 40 now, just to update it, I mean, obviously we look at this most weeks on the show. But what I highlighted last week was that the market had broken out through this downtrend resistance here, which was on the move through 47,000. And you can see the market shot up. It's now begun to consolidate. Last week on the show, I indicated that the RSI, that's your relative strength index, was above 70. And that's quite unusual. It's a very overbought reading for a relative strength index. And typically what happens when you get a move above 70 and then a move back underneath 70, that is what we refer to as an RSI sell signal. It doesn't necessarily mean that the whole market's going to fall in a heap. I don't think that at all. But what it does mean is that we've probably seen a short-term peak for the moment and that we are now in a consolidation phase. And this little consolidation that seems to have gotten underway here now may still have a little bit further to run. And the big support level to monitor now for the top 40 will be down here at 47,000. That would imply a retest of this breakout area that we saw about 2 weeks ago. And that would be quite healthy if we got there, tested that support, and then reversed up off of it. That could then set up another leg to the upside, which might then go and revisit those 49,200 highs that we saw last year.
Yeah. Garth, and this is all obviously key to the option structure that you have and futures closeout, which is next week. And we did discuss it a little bit last week too, but maybe just revisit how you've positioned yourself ahead of next week.
Yeah, well, I mean, what we did, obviously, I've got a complicated call option, or a complicated option structure. It's got a short call, which is at 47,000 net written, which is a problem because the market's now above 47,000. So it means I lose money on that call option, that short call option. But what I did with last week's show was I went long of a top 40 future to hedge it out. You'll see it on the last slide at the end of the show where we illustrate that we're perfectly hedged now. So that option structure has not worked for us. I mean, no. I'll say that up front. It hasn't worked. But we are hedged. And if the market continues to move higher, then it's not the end of the world for us because we've actually hedged out the risk now.
What I meant is to lead us to this chart, which are the various strike rates that you want to highlight.
Yes. Well, what's interesting is just to look at this chart with the open interest at different strike intervals, because the futures closeout is next week, Wednesday. That's the 15th of June. Typically, a futures closeout is usually on a Thursday. It's the third Thursday of every March, June, September, and December. Yeah. But because next Thursday is a public holiday, the 16th of June, the futures closeout now falls on the Wednesday before that, which is unusual. Anyway, it basically means that we've got a week to run until the futures closeout happens. And as we get closer, it's interesting to look at where the market is positioned in terms of options, because you do find that there's a fair amount of derivatives activity that could push and pull the market in different directions as the futures closeout approaches. So what I've done is just highlighted some of the most active strike intervals here. So the lower one there is the 47,000 strike, where you can see there's just over 2,000 puts and calls written at, or open interest at that level. 48,000, which is more or less where we're trading at the moment. There's lots of open interest here, almost 13,000 call options and nearly 10,500 put options open interest. And it's no surprise, therefore, that the market has been fairly noisy around this 48,000 area, and it quite potentially could continue to be noisy. And then up at the higher levels, we've got nearly 6,000 calls and puts at 49,000. So, I mean, I suppose it's very difficult this early on to predict where the market is likely to go ahead of the futures closeout, because obviously we still got to be driven by international factors at the end of the day. But that's where the derivatives activity is, and you can see those strike intervals quite clearly indicated with the option interest there. And you can expect that if the market trades towards any of those round numbers, 47,000, 48, or 49,000, then you could find a little bit of noise around those intervals. As I said, at the moment, we're around about 48,000, and the market's been oscillating up and down above that level now for the last 4 or 5 trading days.
But going back for you, that noise won't necessarily affect the portfolio?
Well, it won't, no,
okay.
Because we're long, and we were long of a top 40 future down at about 47,200 odd. So there's no effect to us. Basically, we're going to be losing money on our option structure, but we're going to be making money on a top 40 long that I took, and they completely offset one another. Yeah. So we're safe as things stand at the moment.
Okay. So it'll be interesting to see what happens next week, Wednesday. Garth, you are enacting a trade for the portfolio. Exclamation mark.
Yeah, lots of exclamation marks, because we haven't been very active this year.
So it's a long on Investec. So why do you like the look of it?
Yeah, it's interesting. Now, what I've got on this chart is Bollinger Bands, and we don't often look at Bollinger Bands on this show. Bollinger Bands, invented by a guy called John Bollinger, and really the way it works, if you look, you can see there's 3 clearly identifiable bands over here. The middle one is effectively it's a 20-day moving average of the price, and then the outer 2 bands are essentially 2 standard deviations away from that 20-day moving average. So the lower Bollinger Band is then 2 standard deviations to the downside, and the upper Bollinger Band is 2 standard deviations to the upside. And this works quite nicely in a sideways trading market or in a sideways trading stock. It doesn't work very well in a trending environment. But because we're in a relatively choppy environment at the moment, we've noticed that these Bollinger Bands have been working quite well on a number of stocks, and Investec is one of these. And what you can see there is, notice the circled areas, how the price has basically been ping-ponging off either side of the Bollinger Bands over here. Now, it's come back down to the lower Bollinger Band this week, and there was evidence of buying yesterday and the day before, and in fact today as well, there's been evidence of buying around this lower level. Your stochastic is becoming fairly oversold, and on that basis, I think it does look interesting for a buy. Also, one of the reasons why the stock has come under pressure is because Investec announced last week that they were raising new or issuing new shares, effectively 30 million shares, to raise £145 million, which they would then use that money to then go and effectively buy back some of their preference shares. And you'll see a lot of the banking stocks starting to do this going forward, because preference shares are no longer going to be considered Tier 1 capital under the new Basel III rules going forward. So all of the banks that have issued preference shares over the years will look to do some sort of a corporate action to redeem those shares, most likely. And that's what Investec's done here. And by issuing those ordinary Investec shares, it has created a short-term dilution in these ordinary shares. That's hence why we see this price under pressure. That's the one reason. And the other reason, of course, is that the rand has strengthened. And with Investec being dual listed in London, the stock price comes under pressure when the rand is stronger.
I mean, just going back, we had that whole discussion on book builds and share and share offers a couple of weeks ago. So are you saying then a purely, well, in your mind, a technical depression on the share price?
I think part of the reason why it's weak is that because there's a short-term dilution,
overhang,
if you like, or
yeah,
a short-term overhang, if you want to call it that, in the market. But for all intents and purposes, nothing's really changed in the company. So I do think that once the market's digested these new shares, you probably could find some degree of recovery in the share price. And I'm not looking for a lot here. I mean, as you'll see on the next chart, this is an hourly chart of Investec here. This goes back to the 25th of May, so you can see the price declining over here, quite a well-defined downward trend. Now, what we've seen over the last, well, this is today's trade, really. Keep in mind, this is a 1-hour chart.
Yeah.
And by the way, this is a screenshot of my IG Markets trading platform. Anyone who trades at IG can pull up a chart like this on their platform. And the break of that downtrend that we've seen there this morning is effectively, that's a buy signal to me. There's a gap in the chart there, in the hourly chart, up at about 107 Rand. And that is, kind of corresponds with another area of lateral resistance up there. So I think to buy on the break of that downtrend now, like I've done this morning, looking for a move up to close the gap at 107 Rand, that's a nice trade. It would imply a small recovery in the price of Investec. I'm not looking to hit it out the park here by any means. I mean, this is, like we talk about cricketing analogies, this one's definitely going to be hitting a single. But they all add up over time. So what I've done is I've gone long of Investec at 102.81 Rand per share on that breakout this morning. My stop loss is at 100.70 Rand, and I'll be a little bit flexible around that stop loss, but I'll monitor that. And then my target is to look for a move up to close that gap at 107 Rand.
Okay. So Garth, in greater detail, take us through the mechanics. Also, interesting that the top of the chart there is, or the range rather, is about 115 Rand, but you wouldn't necessarily look for the share to head all that way?
I don't look in this market. I'm not going to be greedy. We've seen a significant lack of follow through on a lot of stocks. So I think in this kind of market, I'm rather going to take my profits when I've got them and not be too greedy for too much upside. I don't think.
Okay. Well, so, as I said, in greater detail, let's have a look at that.
Yeah. So we've gone long at 102.81 Rand. My stop loss is 100.70 Rand. That means that my risk per share is 2.11 Rand. I'm risking only 1% of our capital here. We've got 277,000 Rand at our disposal. So 1% of that is 2,770 Rand. That's what I'm willing to lose if this trade doesn't work out. I take that capital risk of 2,770 and I divide it by 2.11 Rand, which is our risk per share. That leaves me with 1,312 shares. So I've rounded it down to 1,300 CFDs. My target, as I said, is 107 Rand, and that therefore means that my risk to reward ratio on this trade will be 1 to 2. So I'm risking 2,700 odd Rand for the possibility of making about 5,500 Rand.
Yeah, I mean, I probably wouldn't say this is a massive probability trade, but happy to take it nonetheless, and to take that position size just 1% of their account.
Exactly. I mean, I don't think it's worth hitting it out the park, but it's an interesting setup for the reasons that I mentioned, and I think it's worth having a go. If it doesn't work, we lose 1% of our capital. Nothing ventured, nothing gained.
And I suppose psychologically, it's another way of getting back into the market after having had quite a tricky couple of months. You kind of want to maybe test the waters and just get back in a little bit more slowly.
Definitely, and hopefully there's not a crocodile waiting to eat us. But yes, I mean, that's true. It's been a hell of a difficult year. I've really struggled this year. There's no question about that. I know a lot of other traders have as well. Yeah. It's been a difficult year to trade. Last time I felt it was this difficult was 2011. But anyway, we keep on trying, and it's not always easy. And this shows, like you sometimes say, warts and all trading. This is reality. It's not always easy.
Okay, Garth, so what does the portfolio look like in that case?
All right, so we've got just shy of 277,000 Rand in our portfolio. It's still up nearly 11% for the year to date. I mentioned the option structure, which runs out until next week's futures closeout. We've still got that open. We are losing 11,800 Rand on that at the moment. However, I mentioned that I'd hedged out the options position by going long over top 40 future, and I've done that, and we're therefore making a profit on the future of 10,590 Rand. So you can see there's a fair amount of offset on the future and the options position there. And then obviously that Investec position that we've entered this week is open there as well.
And then, Garth, just to end off with a couple of new courses.
Yes, so I'm going to be doing 2 more courses in the end of July, an Understanding CFDs course on the 21st of July and a High Probability Trading course on the 23rd of July, both of these in Johannesburg. So anybody that would like to attend either of these courses, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Okay, great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.